Thank you, Mr. Chairman, and all of you. I agree with much of what you've said in your opening remarks. Not all of what you said, but I hope we have a chance to talk about the concerns you still raise ahead, and I'll be open with you about the things that I think are the challenges we face going forward. I want to provide, as you suggested, a broad overview of the impact of these programs on our economy and our financial system and the challenges we face ahead. I think it's also very important to recognize at the beginning that it's very hard to separate the impact of TARP itself on the economy and the financial system from the combined impact of the broad strategy this government embraced. And of course, as you know, that strategy included very creative, powerful set of programs by the Federal Reserve, a set of very powerful actions by the FDIC, the substantial support in terms of tax incentives and investments that came in the Recovery Act, the support for Fannie and Freddie that was required to avoid collapse alongside the TARP programs. None of them would have been as effective without the overall package. Monetary policy doesn't work without a functioning financial system. TARP would not have been nearly as effective without those other instruments. That's an important thing to recognize. I think it's important to recognize that the shock that caused this Great Recession, that caused this crisis, was larger and more powerful and more dangerous in the view of economic historians than the shock that precipitated the Great Depression. And yet, despite that, 2 years after the peak of the crisis and 2 years after TARP was first passed by the Congress, the economy has now been growing for 18 months. We've had roughly 1.2 million jobs created by the private sector, more and more quickly than followed the last two recessions. Household wealth has improved very, very substantially over this period of time. The tax package that was approved by the Senate yesterday and based on the comments made by the House leadership, both Republicans and Democrats, that's likely to pass the House this afternoon, provides a very powerful package of support for middle-class families, for working families, for the unemployed, and a very powerful package of incentives for businesses, which we believe, and I think most economists believe, will add substantially to our prospects for getting the economy growing more rapidly and more people back to work in the coming 2 years. I think it's fair to say that the worst part, the most dangerous part of this financial storm has passed us, but the crisis has left a huge amount of damage in its wake. Millions and millions of Americans are still out of work, at risk of losing their homes. Unemployment remains, on average, nationally at 10%, but much higher in many parts of the country. And it's going to take years, not months, it's going to take years to fully repair the damage caused by this crisis. Now, the government's financial programs, including TARP, but not limited to TARP, were not designed and cannot solve all those problems and cannot on their own solve all the damage caused by the crisis. But these programs did what they had to do, what they were designed to do, which was to protect the value of America's savings, to restore a measure of stability to a financial system at the edge of collapse, reopen access to credit, and to restart economic growth. And these programs did so much more powerfully, much more effectively, much more cheaply, much more quickly than I think really anyone, including their architects, thought was possible 2 years ago. Now, you can see independent evidence of that conclusion, support of that conclusion from a range of different sources, including the work of the panel. Mark Zandi and Alan Blinder published, I think, the most definitive independent study of the effects of these programs over the course of the summer. And as you know, they concluded that without these programs, the economy would have fallen by another 3.5%, would still be declining. Unemployment would be above 16%. We'd be at risk of a downward spiral of deflation. No one knows for sure how bad it would have been, but as I said, if you look at the magnitude of the shock that caused the Great Depression and how that crisis turned out for this country, against the evidence of what these policies have provided in this brief period of time, I think it's a very good record so far, acknowledging that, as I said, the damage caused by this crisis is overwhelming still, and it's going to take years to repair the damage. Now, let me just review some of the other basic estimates we use to judge where we are today. As many of you pointed out, these programs achieved their objectives at a fraction of the cost that almost any observer predicted, even as recently as 3, 6, 9, 12 months ago. The CBO estimates, which we all rely on because they're independent, initially estimated TARP itself would cost $350 billion. Those estimates are now around 25. They are too high, in my judgment. Ultimately, they'll be lower. The most important thing to point out is that The investment programs in TARP means the combined investments we put in banks, in AIG, to support credit markets, in the automobile industry, those investments together will show a positive return. The losses will be limited to the amount we spend in our housing programs. The investment programs in TARP will show a positive return, not a negative return. The taxpayers will earn a positive return on those investments. Now, if you look more broadly, as many of you suggested, at the combined costs of everything the Fed did, everything the FDIC did, the losses we still face because of what Fannie and Freddie did before the crisis, and TARP together, on reasonable estimates about the future, those total costs are likely to be less than 1% of GDP, which is less than 1/3 of the cost of the savings and loan crisis, which, as you know, was a much milder, much more limited financial crisis. And if you look at the costs of crises across many countries over time, the direct financial costs of these programs, all in, including the GSEs, the Fed, FDIC, and these programs, is likely to be a small fraction of what we have seen almost anywhere in history over this period of time. Now, we are moving very, very aggressively to exit from the government's investments, from the guarantee programs, from the emergency crisis response as quickly as possible, and we are way ahead of schedule in achieving that objective. You know, we've recovered a very substantial fraction of the investments in banks. When I came into office, the government had invested, and they needed to do it. It was the necessary thing to do. It had invested in banks that represented about 3/4 of the entire American banking system. Our remaining investments today are in banks that represent only 10% of the American banking system. That's happened in just over 20 months. As you know, and I'm happy to go through these in more detail, we're substantially far along the road to definitive exit from the automobile industry, from AIG, and of course all the nation's banks. Now, as many of you have said, a key test of crisis response is, are you leaving the system stronger than it existed before the crisis? And in contrast to what you said, Mr. Silvers, the American financial system today is in a much stronger position than it was before the crisis. There's been a very dramatic restructuring of our financial system. The weakest parts of the system no longer exist today. The remaining institutions had to pass a very rigorous test for market viability. They have much stronger capital positions than they had before the crisis and are much higher capital positions than is true for their international competitors. And the Dodd-Frank bill gives us tools for oversight, for crisis prevention, for crisis resolution, to limit moral hazard risk that I believe will be the model for the world going forward and address the critical weaknesses that help cause this crisis. So for those reasons, because the system is in a much stronger position today, if growth in the future, economic growth in the future, proves weaker than we would hope, it will not be because of the remaining challenges in the financial system. It will be because this was a crisis caused by millions and millions of people taking on too much debt, and it takes time to grow out of this crisis. It will not be because the financial system is providing a constraint on access to credit on a scale that would limit future growth. Now, Mr. Chairman, could I just make a few final remarks?
Sure. We'd like to questions.
I'm moving to conclusion.
Yeah.
Now, we face a lot of challenges ahead. We're going to go through those. I just want to list what those are in my perspective. Obviously, they're housing, small banks, access to credit for small businesses in particular, the challenge you referred to, Mr. Chairman, of winding down prudently, carefully, protect the taxpayers' interest in what's still a very complicated set of investments in the remaining financials in the system, implementing Dodd-Frank, and laying out a broad reform for the GSEs in the housing finance system. That is a lot of work. Overwhelmingly, though, the biggest challenge facing the country is how to get the economy growing at a more rapid rate so we can bring down the employment rate as fast as possible. That's the most important thing we can do for housing, for small banks, for access to credit more generally, and that's going to have to be the principal focus of the administration and the Congress's efforts. I want to just conclude briefly with two final remarks. I think it's very important. You guys have been very gracious, but it's important to step back and give credit to my predecessor as Secretary of the Treasury, Henry Paulson, to the Federal Reserve Board and staff, to the men and women of the New York Fed, to Chairman Sheila Bair, and the architects of these programs at the Treasury, including, and I want to list them for you principally, they are Lee Sachs, Herb Allison, Tim Massad, and Matt K. Baker. They designed a very complicated set of programs in a very short period of time for which there had been no precedent in modern financial history, which, as you have acknowledged, have been much more successful than almost anybody expected. And, of course, they did the necessary thing. And I want to conclude by just acknowledging how important the work of this panel and the other oversight bodies that were established to look at what we were doing. I think one of the great strengths of our country is that we subject the judgments of public officials to very difficult, rigorous, independent oversight. I don't agree with all the judgments that you have made or the judgments of the other oversight bodies we've been faced with, but you play a necessary function. It's part of rebuilding confidence in public institutions in the United States, and we have been very careful where you've made recommendations that we were confident would improve our programs. We have adopted those recommendations. And, of course, we'll continue to do that as we go forward. I welcome a chance to talk about these things with you, and I look forward to being able to respond to some of the other observations you made in your opening remarks.
Thank you, Mr. Secretary. In your written testimony, and a member of the panels have said this is discussing the CBO $25 billion number. Are you comfortable with that number as being the total cost for TARP?
I think it'll be a little high. You know, these things are very uncertain. They depend hugely on what happens to the overall economy and to financial markets. But based on the things you can observe today, where there's a market price for an investment, and based on what's reasonable to expect, I think, about the trajectory of our housing programs, I suspect the number will be high.
You've talked, and the panelists too, about how well things are doing right now in the financial system, corporations, and things like that. And the main reason for this hearing is kind of figure out what do we do to finish this out and do the best we can, realizing October 3rd limited modifications things to make. But what's your thoughts on what you can do in the rest of TARP to get the banks to start lending more money?
TARP's contribution to the financial, to the remaining challenges in our financial is largely over. We have authority still to continue this set of housing programs to make sure they reach as many people as we can. Beyond that, TARP's contribution will be very limited. The principal thing we can do to help small banks manage through this, make sure that we're doing as much as we can to reopen access for small businesses to credit. The burden for that's going to fall on this new small business lending facility that Congress passed in September of last year.
So just, I mean, you basically feel that under TARP, there's the fact that banks have all this trillions of dollars on hand and not loaning is something that has to be dealt with in a different way other than under your TARP.
Yeah, I think this is a really important thing to look at. What matters in crisis response is to get credit flowing again, because it's the oxygen that economies require to recover. How should you measure how effective these programs were in this context? The only real measure you can look at is what happens to the price of credit. How much it costs for somebody to borrow, a business to borrow, for a person to send a kid to college, for a municipal government to borrow to finance critical services, cost of a mortgage. And all those measures of the cost of credit, as you know, we're at panic levels in the fall of '08, and we're at panic levels in the early '09, but have come down dramatically. If you look at how much banks are actually lending volumes are lower than they were before the crisis. But that is necessary, no surprise, because this was a crisis brought on by the reality that people had borrowed too much. And when the economy shrinks, the actual outstanding volume of loan is going to fall. But the test of whether credit is more available or not has to be measured in the price of credit.